Atocha Global Analytics. Please like and subscribe.
Hey everybody, KT here with Atocha Global Analytics. As always, I want to remind you that Atocha Global Analytics was created to provide insight and foresight into the street-level impacts of macroeconomics, real estate and finance trends, and the policies that shape them. And today we're going to do something a little different. It's something I've been wanting to do for a while. What I'd thought would be maybe a video or even two has turned into a multi-video series. And, you know, there's a lot of home buyer guides out there. There's a lot of people that try and tell you where the market is and what have you. But there's very few people out there that are willing to tell you definitively where the market should be. So this series is entitled, How Do You Figure Out What a House Should Be Worth? And, you know, it's not rocket science. And look, I can only shoehorn in just so much. But you know, honestly, the historical trends are there. And whether interest rates go up and down determines how much people can afford. It of course, changes where supply and demand should settle. But the reality is there's a lot of benchmarks out there that are very fixed. And those fixed benchmarks will eventually draw things into some sort of normalcy. And they say that everything reverts to the mean, or, you know, it's regression or reversion to the mean or the median in some instances. These are two obviously statistical measures. And so that's what we're going to delve into a little bit. But so here's the plan. In advance of what I expect will be a collapse of the Florida housing market here in the next couple of years, I want to help those that are wise enough, whether it's a buyer or investor, I want them to know what they should know in order to prevent purchasing an overpriced home. So here's the goal. Going to give you some tools, going to break it down into some components, and this is going to be very empowering. So what you're beginning to view, it's really a culmination of literally decades of my experience as a real estate analyst. I've also spent better than a decade doing financial modeling for acquisition of real estate. I've done about $200 billion worth of real estate modeling. That's 1/5 trillion in another way of saying that. So that's what's being broken down here and providing you insight. So, you know, again, the house has several parts. We're going to talk about how each of those parts contribute to value. You're going to need some sources in order to apply the principles that are used here. You're going to have to, at some point, talk to some builders. I'd recommend talking to some independent housing contractors in your area that are building homes in essentially the type of home you will want to purchase. If it's a more modest home, talk to people that are building homes like that. Not necessarily these large tract home builders, though it can be somebody who's doing a tract of land as a subdivision, but it has to be an independent guy. Don't try and talk to somebody who's got a big corporate parent. You also want to talk to brokers and agents, but sparingly, very selectively. You know, they're salespeople. In my experience, they're invariably way too positive. They don't believe that real estate is ever a bad investment because that harms their business model for their own personal income. So be very selective about who you talk to and who you believe. I believe that appraisers, if they're knowledgeable and experienced, they can be an incredible help. But you have to be a little bit careful in dealing with them as well, because sometimes appraisers can be, one, a little bit too pessimistic, or two, they aren't really doing the fundamental analysis that you think they should be. They're operating day in and day out within a fixed market. They know it geographically, they know the general trends, so they don't really know the fundamentals that are driving things. They just know how the pieces are fitting together day to day, so they can just do their job, get that job done, get on to the next one. You may also need to be able to get some public records information. Almost everything is online now, and there may be some online searches that you'll have to do to get some key information. Nothing that is too complex for the average person to easily do. So let's get right to it. What's piece or component number one? Piece or component number one is the lot. All right, so to talk about lots, I want to give you some insight into. I have this beautiful area that was in the heart of my coverage area when I owned my real estate appraisal firm before I sold in 2014. I handled almost all the commercial, did a lot of high-end residential when it was required, oceanfront, that sort of thing, or very, very unique residential properties. But I did mostly commercial, expert witness testimony, that sort of thing. And but I had not just the commercial department, I had a residential department that did a lot of conventional homes. So we had a ton of data. And I still retained all that data. And some of it even continued after I sold in 2014. So I want to explain a quick premise to you. But first, let me describe the market where this incredible amount of data came from. So the market that I'm talking about, there's one particular city. It was developed in mass where there were just literally tens of thousands of lots created in just a matter of a handful of years. And it has been gradually building out those lots for decades. Example from June 2002 through early 2005, just under 3 years, the population of this city grew from 100,000 to 150,000. It was incredible explosive growth. And then it actually plateaued at around 160,000 for over 5 years. It had a little bit of fluctuation up and down. And then it's gradually been growing again until the last few years when things got very, very hectic. But we had all these generally uniform lots across a wide swath of land in coastal Florida. And so you had these lots almost invariably 10,000 square foot lots. And so very little deviation for view premium, very little deviation for size. It was just neighborhood to neighborhood. Some were more developed, some were virtually undeveloped where these transactions would occur. But we had a tremendous amount of data. And a lot of these lots were selling. So going back in time, they were selling, but in the 90s, really before the big boom, before the great financial crisis and great recession. So we have a lot of data then. So let me describe this premise, and then I'll show you an example of the variances in lot prices as we went through a boom and bust cycle. So let me just describe for you a couple scenarios. All right, so few people would take a $50,000 lot and build a $5 million McMansion on it. It just wouldn't happen. Similarly, if you had a $2 million waterfront lot or oceanfront lot, if that lot's worth $2 million, you're not going to build a $250,000 house. It's very typical for what you'd find in a tract somewhere. Chances are you're going to build a McMansion on the waterfront lot, right? So here we show what's called an over improvement. You have a lot value of $50,000. You have a McMansion house cost of $5 million. The under improvement, the other scenario, the under improvement, you got a waterfront lot that's worth $2 million and they're building a $250,000 house on it. That's typically not how it's going to work. This is what it's going to typically look like. A typical development, you will have a $2 million lot having a $5 million house built on it for $7 million in total cost or value. Similar for a tract home, you'd have a $50,000 lot with a $250,000 house being built on it, creating a $300,000 value for the house and lot. And so if you look at the ratio between the lot value and the aggregate improved house value, house and lot combined, you see that there's going to be a pattern there. With the waterfront lot, it's 28.6%. With the tract home, it's 16.7%. So these values, how they associate to each other, they literally are going to form patterns. And over time, different aspects of the cycle, whether it is caused by maybe there's a problem where there's a shortage of materials, kind of like what there was with COVID. There was a severe shortage of materials. It skewed the price of homes, but it also slowed development. So distorted that way. And then, of course, we had ultra low interest rates, which accelerated Of course, post-pandemic, everybody's wanting to move to Florida. So we had this big explosion in demand in Florida at that time. So prices, of course, skyrocketed. So these are distortions, whether it's because of financing or patterns or shortages of material, whatever. These distortions cause things to deviate from norm, but eventually it will revert to normalcy. So with that general premise, I want to describe to you what happened in the past as an example so you can see boom and bust. And so you can apply that same concept to today, because lot values, as I will show you in just a moment, were really significantly impacted back in the early 2000s, back at a time when inflation was low, but there was a big boom in real estate. So if you go back to January 2002, lot prices in this city with all these 10,000 square foot, it averaged about $10,000 per lot. And it cost for site costs. When I say site costs, you have to think of some basic fill, some clearing, the fact that there's got to be a site survey. There's going to be some impact fees or building fees of some sort associated with the city that you may have to pay early on. But there's some initial site costs to turn a vacant lot covered with trees and bushes to a lot that is not necessarily ready to pour a foundation, but at least it is clear and it's got sufficient fill to where it's level. There's no low spots. There's no extreme high spots. It is a buildable lot, which we now typically call a site once it's prepared like that. All right. So a new home back in January 2002 in this area, $130,000 as a package. If you went and got, and there were a couple of roadways that just had these house after house that were model homes for these builders. They were their showcase. You'd go in there, the model center, you could see one or two models built side by side. A couple of them had 3 or 4 in a row. And you'd go in the office, you could pick out all your things, and they'd give you a price right then and there. You provide the lot, and we come in and do the rest. And so a new home in that environment was about $130,000. And then site improvements, that's your 2 trees and a bush, your driveway, your entry walk, and maybe a patio. Of course, included in that, you're going to have, some other landscaping. You're probably going to have grass, but that's not extensive site improvements, not a swimming pool or anything like that. So you had the site improvements, so you had a package price of about $156,000. You could go out and buy a brand new home 21 years ago for about $156,000. So you fast forward a little bit. 4 years later, and that same lot, instead of being $10,000, is now $105,000. Yes, it broke over $100,000. The site cost went up a little bit. There was a little bit of inflation. Things were busy. Cities were raising their fees because their building departments were swamped. Our growth management department was just utter chaos. But the cost to build homes, we had Chinese drywall. We had steel shortages because of China. We had concrete shortages because of the giant dam and Three Gorges Dam in China was sucking up so much concrete. So we had some costs that went up, but it wasn't generally inflation. It wasn't general inflation. It wasn't hitting the food and the energy and some of the retail costs like it has been this time. But you did at least have some construction cost inflation primarily due to materials. So a new home costs $205,000. And the site improvements, the bushes and the trees and the grass went up a little bit because there was a lot of demand. So it was about $10,000. So if you were going out and buying a brand new house in this particular city, it was about $330,000. And it was a great area to just develop this really significant depth of data so that I can demonstrate these things for you here. So you fast forward a little bit, and of course we had the financial crisis, we had the subprime crisis, we had the Great Recession, and really the real estate market. Most homes are selling far cheaper than what you could even have purchased them for literally in 2003 or 4. These homes, the lot value specifically went from 105,000 to 10,000 again. It went right back where it started. But of course, the construction costs had gone up and they didn't really come down. Site costs actually continued to go up because now instead of having too much work, the municipality that had been overwhelmed and swamped with work, where the growth management was overwhelmed, now it wasn't getting enough revenue. The taxes had cratered. Property taxes were dropping like a stone because values had dropped so low. Literally, because of the short sales and foreclosures, homes were selling far below what they really should be. You were literally getting the land for free if you looked at it from a value standpoint of what they were selling at. So, new homes at that time were costing about 195,000, and site improvements cost a little bit more actually, even in 2011, despite the fact that it had gotten so slow. And so a package price at that time was 231,000. So why go through all this? Well, let's look at the lot price. First, the lot price went up over 10 times, but then it went right back where it began. A great deal of the value up and the value down could be attributed just to the lot. Of course, construction did go up some. It went up 58, almost 60% in 4 years, but then it dropped back slightly, but only slightly. So the package price, you can see it went up 112%, but it only came back down about 30%. And so the lot to package percentage here, you look at it, it was only 6.4% at the beginning of all this, which was a normal market, but it had just an incredible supply of lots. So it went up to almost 32% of the package attributable to the lot in 2006, which was way above what the historical norm should have been if you look at other more normalized markets. And then in January 2011, it dropped back down again. It ended up 4.3% of the typical package. And in some cases, it was literally where the land was no contributory value if you actually calculated it out when you're looking at existing homes, because they were selling so cheap, because they were competing with short sales and foreclosures in order to sell. So let's look at recent history. We'll go ahead and fill in 2011 because we just covered that. So let's fast forward to 2015 here, and you will see the lot prices were up to about 25,000. So they had come up somewhat. The time on market for a typical home was between 3, 4 to 5 months, depending on the neighborhood. Sometimes things were moving a little better in some neighborhoods than the other, but it was a good, healthy market. Everybody uniformly in the real estate business, especially those that had, say, 20 years of experience with real estate, they said, you know what, this is a healthy market. It's normal. Another key thing is interest rates had been generally flat. They hadn't gone up or down significantly. Everything was just chugging along, not on fire, but also not slow, not problematic. It was just a nice balanced market. So of course, site costs were still running about 14,000. The new home costs had gone up a little bit again. It was up to 219. Site improvements had gone up a little bit again to about 15,000. So you see the package price in 2015 was about 273. So fast forward to January 2023, which January 2022 and January 2023, there wasn't really a whole lot of difference. So I could use January 22 just as well in that space. So lot prices had made it up to $110,000. Site costs had gone up again. Of course, new home construction costs had gone up again significantly. Site improvements again had gone up a bit. So a package price for a brand new home was averaging $458,000 in January. So let's look at the lot price. All right, it went up 5 times, or 2.5 times. It went up 250% in January in the 4 years from January 2011 to January 2015. And it went up again almost 3.5 times from January 15 to January 2023. So it had gone up literally 11 times over the 12-year span. Whereas construction prices had only gone up 12% in the 4 years from January 2011 to January 2015. and it had gone up a total of 42% from January 2015 onward. So the package price, you can see it only went up 18% as a package, and it went up 68% as a package in the following 8 years. The important thing is a lot of this increase in value was still absorbed by the lots, a very large portion of it. And if you look at the lot to percentage, of course, like we said before, 2011 was 4.3%, which was literally zero in cases of many existing homes. January 2015 was 9.2%. Might have been a little bit low when you compare it to other areas, but there may be some factors driving that. We'll get into that in a later video. But in January 23, it was up to 24%. I'll note that it is not nearly the 32% or so that we saw at the height of the market in January 2006. However, it is still way beyond what is normal. So how do we find normal? And I think that it takes a little bit more analysis than just say this is what it is. But how you find it is by determining what the appropriate percentage is over time. You can look at certain snapshots when the market was healthy, and each area is going to have a little bit different definition of what healthy is or what the ratio is. But the ratio where it is healthy in this market is between 9 and 13%. That is it over historical norm, 9 to 13%. You look at other areas in the same general market, but outside of the municipality. So it's not impacted by the taxes. So it's not impacted directly by locational factors, and not skewed necessarily where it's a much superior, more market preferred is a term we used to use a lot, market preferred area. It's not necessarily a market preferred area or not significantly more market preferred than the area that you're analyzing. But that will give you a good indication of what normal is if your particular area seems to be skewed. So in our area right now, 24% is way overpriced. So what should it be? It should be in the neighborhood of 11 or 12%. And so we will circle back to this, and that's for the lot. That's not including the site costs or these other things. But there are a lot of locational factors that can be an issue. For example, I'm talking about a particular municipality that is between 1 and 1.5% higher in its property taxes than a lot of non-incorporated areas nearby, or a part of the broader market that is within 15 miles away. And you can see directly reflected in the numbers how the taxes and some of these other factors directly impact values. So that's component number one. That's lots. Now we're going to have to touch on that again, but we have to build on some other parts so we can explain why the normalcy is established that way, or how that normalcy is established. So in summary, it's about lots. You need to be able to find lot sales, and you have to determine when the market was healthy and see what typical lots, like what you are intending to have as far as the home you're going to buy. Again, it doesn't matter if it's for personal use or whether it's for investment. If you're planning on buying a home, the land under it is quantifiable. You can value that fairly easily, or find out what the contributory value of it is. So if we find what that value should be instead of what it is, if you buy when the lots have returned to that value, you can buy a home and be relatively well assured that even if the market is in crisis and it's a crash, the market will at some point in a reasonable period of time return to normalcy and be established at a particular value. It's not a matter of trying to time the bottom. It's trying to time at least normalcy when you reach a normalcy, so that you don't buy something, even if it does go down below normal, it will quickly revert or recover to normal within a reasonable period of time, so you don't spend money you shouldn't unnecessarily. And with that, I'm going to go ahead and close out this video. I wish that I could impress upon you just how insightful this information is. I've scoured YouTube, and there's just nobody else that is really breaking it down in the right way. I think a lot of people are scared to share real numbers with people so that they can understand how these pieces fit together. We're dedicated to doing that. When we say the street level impacts, we mean for the street level investor, we mean for the individual buyer, seller, homeowner that wants to make a wise decision when and time it appropriately where they buy smartly, use wisdom and discernment about when to buy. So if we can help you with that, that's what we're here for. I ask you to like, subscribe, ring the bell so that you will know when other things are coming. We cover a lot of commercial and a lot of investment-oriented information on this channel. We want to provide that with the experience that we have on staff here, whether it's in economic analysis or in real estate market analysis. We model numbers. We are not investment advisors. We're not giving investment advice. We're giving market advice, and we're showing techniques. We're showing techniques for valuing a property. We're not showing you how to invest in it. We are not providing investment opportunities. The Atocha Property Group specifically specializes in modeling investments. We are not actually selling the properties. We are structuring the financial side of the investment, doing a financial model that indicates where the appropriate purchase price is and the appropriate repositioning to make a particular performance on an investment. But anyway, with that, we've covered everything for today. We're going to move on to the next component number 2 with the next video. See you in part 2.
Atocha Global Analytics was created to provide insight and foresight into the street-level impacts of macroeconomics, real estate and finance trends, and the policies that shape them. What is happening in the financial world today shows us that those of us on Main Street are in a street fight for our financial futures. In order to win this fight, we need to become truly streetwise.